We'll let the stragglers kind of come in. Want to thank everyone for coming tonight. I don't want to take much more than an hour. I'll try to get through the majority of what I'd like to talk about tonight and then give you plenty of opportunity to ask questions at the end. A couple of housekeeping items. What you have there in front of you, there's a little half sheet. If you find out that there's some things that you have further questions, need more time, please, if you want to, put your contact information down. Any of those things that interest you, or if there's not, add something that you're interested in, and we'll see if we can help get some answers. Someone here at the bank, I'm sure, can help answer any of the questions you might have in regards to anything financial. So we want to help. We want to be a resource for the community, and we don't just do loans here. So we want to help with everything that you need financially. And then please feel free to stop me anytime during the presentation, and happy to answer questions. So tonight we're going to be talking about how much do you need for retirement. Now I'm going to preface tonight's meeting with we're going to be talking about things from a high level here, okay? So a very general way to look at how you can, get some solid estimates for what you need in retirement. The reality is everyone's needs are different, everyone's lifestyles are different, therefore what you actually need is different. And it might take a little bit more detailed thought than what we're going to go to in this meeting tonight, okay? So as I was preparing for this meeting, I wanted to have some statistics for you. So the Bureau of Labor Statistics put out some information in July. And the average retiree, that's 65 and older, in 2024, the average annual expenses that they have is about $52,000 and some change per year. So that's a little over than $4,300 a month. I didn't go into if they're paying a mortgage. This most likely does not include a mortgage. It's just your medical expenses, food, utilities, cell phone, maybe some travel, minimal travel. This is just the basics, okay? With inflation where it's at, 4 years ago, this number was probably more like $48,000. Okay, so obviously prices of goods and services are going up, and that's something you need to plan for in your retirement, not just these numbers. Now, these numbers that we're going to go through today do account for a 2% inflation. But if we have more years like we had in 2022, 2% might not get you there. So that's why I say more detailed planning is important. Now, as a rule of thumb, what do you need for retirement? If you take your last years of salary, plan for 60 to 80%. And I would say get closer to the 80% side, just so you have more cushion. The last thing that you want to experience is not having enough money. And the goal is, when I meet with my clients and work with them, we don't want them to outlive their money. That's the worst case scenario, that you live longer than you have money. Now, the one question I can't answer is how long you'll live. So, what do you plan for? Well, I would say plan to live a very long, healthy, happy life. Whatever that is to you, well, that's how you need to plan for it, okay? So 60 to 80% of in your working years, what's the, maybe the last 3 years, what's the average? Take 80% of that, and that is the number you need to start with. And that is the first question that is on your worksheet. So let's take a look at that worksheet. That very top line. I want you can either just sit and think, but basically the majority of this presentation, we're going to go through this together, and we're going to work on it. So whatever that number is, 60 to 80%, I'll give you a couple of minutes to kind of figure that number out. If you don't have an idea, maybe a good starting point would be the average, the annual average expense. What do you need in retirement? We know on average, retirees need at least $52,000 a year. So bare minimum, if you don't have that number, I would put that number down, okay? Give you a minute to write that down, and we'll move on to the next one. The next big thing is line 2. How much do you expect to receive from Social Security? If any of you haven't done this, you can actually go to myssa.gov. Doesn't matter how young you are. As soon as you get a Social Security number, and as soon as you start paying taxes, this is going to start getting calculated. So at any point, you can go in and you can set up your account with myssa.gov. Highly recommend it. Couple reasons. First, you can go in and you can estimate. What if I retire at 62? Well, they're calculating it for you. Based on what you've paid in taxes so far, they're going to calculate that for you. What if I want to retire at 65? They're going to estimate that for you. What if I want to retire at full retirement age? They're going to tell you. What if I wait till I'm 70? They're going to tell you. So you can play with scenarios there in myssa.gov. It's free to set up account. They actually have it's a very secure process. It takes a little bit. You're going to need a cell phone and a piece of paper to write down your passcode phrase. So I highly recommend that you go in. If you don't know what your Social Security benefit is going to be, I have the average for you in 2023. So the average Social Security benefit in 2023, December of 2023, the average Social Security benefit was $22,602 per year. So unless you know what your estimated Social Security is going to be, this would be a good estimate to put in line 2. Okay? Number 3, how much do you expect to receive from your company pension? Okay, so depending on your situation, this could be 0. For me, State Bank doesn't offer a pension. So this would be 0 for me. If you work for the state, government entity, or some of these old corporations that still have pensions, if you know what that number is, this is the place to put that annual benefit. If you are a teacher or working in some form of government job and you don't know, then I would also go off the average. The average Utah government pension benefit is $28,632 per year. Okay? But if you don't know, I always say be more conservative in your estimates. And if you have more in the end, then that's great. You want that. It's better to have more than not enough. All right. Everyone good to where we are, line 3? Anyone need a little more time? Okay. Let's go to line 4. This is what I want you to do. Take line 2, add line 3, and it's going to give you line 4. Okay? The reason why you need to know this is because if you have pension assets that you're going to get in retirement and Social Security benefits, that's all contributing towards your retirement. We need to know that. That's a good base foundation to have. All right. This is the other hard question. How many years until retirement? You're going to put that number down. As a general rule, most people say 65 is the year that they retire. And that's just because that's when you can apply for Social Security, Medicare. For those who haven't retired yet and aren't 65 or older right now, then if you retire at 65, you're actually taking an early Social Security benefit. Based on your age, Majority of retirees, 66 and 10 months. And it's actually averaging more to like 67 and 10 months is the average full retirement age now. So, what is right for you? Again, be more conservative. And in this, I would say choose earlier. Because if you choose earlier, then you know if you have a lack in the end, then you need to make up for it. Either you need to work longer or you need to save more. Okay? So be conservative. Everyone good there? Ready to move on? If not, raise your hand. Okay. Line 6. We're going to take line 1 and subtract it from line 4. If that is a negative number, that's really good. Okay? That means you're already fine. Okay? If it's positive, that's okay. Don't worry about it yet. So take line 1, subtract it from line 4. If you need help, let me know.
If it's 0.
If it's 0, that's a good thing too. Just leave it 0. It'll all work out in the end. It's a very good thing. All right. Now, we're going to be using table A, okay? However number of years you put in line 5, find the closest year, number of years, and whatever, if it's within 5, choose that number, and then the one next to it in table A, put that factor there on line 7. If you have questions about that number, please let me know. I'll help you figure that out. Everyone good with line 7? All right, line 8. You are going to calculate whatever you put on line 6, multiply it by line number 7. Once you get that number, that is the amount of money that you need to retire, according to that year that you put. Okay? Now 0, it's going to be 0, right? Okay? That's because either your Social Security and pension benefits are going to provide enough for your retirement, generally speaking. Okay? Is anyone surprised by that number? You got 0? Okay. Did anyone have a negative number? You had a negative number? Okay. Then I would say you have room to adjust on what you need on line 1. Okay, so if you put 0, if you got a 0 or a negative number, it means you can probably adjust line 1 higher. Okay? And then you can go through that process again. So the larger line 1 is, the more, if you want $100,000 a year in retirement, well, what does that mean you need based on what you already have? So depending on the lifestyle that you want and need in retirement, line 1 is going to help you determine that. Okay? If you have a positive number, then that is the number that you need to have to be able to retire at that age that you put down. Okay? Questions? I see confusion. Any questions?
I'm getting like a 2 million number, so I don't think that's right.
It's not off. It's not off. So you think, if your retirement is 30 years and you're going to withdraw $50,000 to $60,000, $70,000 a year, you need quite a bit of money to be able to retire at that amount, right? On average, in today's world, with the average Social Security benefit and the average pensions that are out there, or those who don't have pensions, because that's the majority of reality now. Most companies don't offer a pension plan. They don't exist anymore with new companies. 401ks are the new retirement plan now, and that's where you make up for that number, right? And so, on average, you need about $1.3 million to be able to retire if you don't have a pension and you get the average Social Security benefit. And that's your two sources of income. Like if you have business income or real estate income, we're not including that. But if you have Social Security and you have your 401k or your IRAs or whatever savings accounts you have, then this is what that number is calculating, okay?
For the factor how much you have saved for retirement, would you be including like 401k current numbers and stocks and
Everything. So that's a good segue. Any more questions before we move on to the next section?
I got one quick one.
Sure.
So I ran two different numbers. Retiring at 65, I did that one, and then where I would like to retire would be 10 years earlier than that.
Bigger number, right?
That's a much smaller number than the 25, retiring in 25 years.
Should be bigger.
So if I retired in 15 years, which I would be 55, would be just at 2 million, and then retiring 25 years. So I think maybe it's just not accommodating for those extra 10 years. Does that make sense?
So if you retired in 15, you would want to calculate
So
34.8 multiplied by times that. So 34.8 times that number. And then do 25 years.
with that number,
Mm-hmm.
so that's that one.
Mm.
So I think what the imbalance is that here we'd be accommodating for 35 years of retirement versus 25 years of retirement here.
Yes. Yes. And this will come into play
So
down
just-
here.
I should probably just add that to that. Right?
Yeah. That's the much safer way to go. Okay. Everyone ready to move on? Okay. So now we're going to talk about the amount that you need to, on the day that you retire, to live 25 years in retirement. Okay. That's what you did on number 8. But how much do you currently have saved for retirement? So we're gonna, every liquid asset, so savings accounts, CDs, IRAs, 401ks, 403bs, whatever you have out there invested, regular brokerage accounts, estimate what that number is, and you put it in line 9. Okay? Go ahead. Go ahead.
So if you have a second property, a vacation property, would you count that as?
Only if you're going to sell it. If that is producing income, then what you need to do is you need to add that into the pension side. Because if that's where you can put all the extra income that you get, whether from a business or a pension, whatever that is on an annualized basis, that's where you want to put that. So only use that if you're going to sell it, and then take the cash and live off the cash. Okay. Okay, in line 10, you're going to use table B. So however many years you're going to retire, find that closest number on the left, and then find the corresponding factor on the right. And then in line 11, you're going to multiply line 9 and 10 together. So what this is doing is calculating what you have saved up now and what it's going to be worth in the future. And we are assuming that you're getting an 8% return. Now, is that a good number to use to estimate? I think it is. It's conservative. Because if you're investing your money and it is performing against the S&P 500, if I say the S&P 500, anyone know what that isn't? Okay, so if you are averaging what the S&P 500 has averaged over the last 50 years, you're going to average 10% each year. Okay? And that's as easy as going and buying an index fund at Charles Schwab or Fidelity or any of these online exchanges, and you're going to average 10% per year. Just doing that. So if we're only averaging 8% in our planning, then we're being conservative. Okay? So line 11. Now line 12, you're going to take line 11 and subtract line 8. And if your line 11 is equal to or greater than the value of line 8, then good job. You could be well on your way to retiring. If it's less than, then there's a surplus that you need to make up for. And either you have a couple choices here. Either you need to work longer, or you need to save more, or maybe do both. Maybe do a combination of both. There's some other things you can do. Maybe you need to be a little bit more aggressive in your investments. And, if you can average 12% or 11% instead of 8%, that might be enough to make up the difference. So you can see when it comes to retirement planning, how you're saving your money, how it's investing and working for you, it all comes into play when you get closer and closer to your retirement. All right. Let's move on to the next line, line 13. How much are you contributing annually to any retirement account? So I'm going to say how much are you contributing to savings, how much are you contributing to IRAs, 401ks, and whether you include what your company matches, if they do match. The more conservative thing is just to calculate what you are saving. And if you have company match, then that's just going to be more icing on the cake. Okay?
How much can you contribute yearly? I forgot. To your life IRA.
Let's talk about that. Okay, so Traditional IRAs and Roth IRAs, you can contribute up to $7,000 a year right now. If you're over the age of 50, you can do an extra 1,000 on those. So if you're over the age of 50, you can do 8,000. Now the requirement is you have to have earned income. To be able to contribute to a retirement account, you have to have earned income. So it can't be passive income from rentals. It has to be W-2'd income, or if you're a business owner, it has to be income that's passing through to your 1040 and you're paying wage, Social Security, Medicare taxes on those dollars, okay? Now, why would you invest in a traditional IRA versus a Roth IRA? It all based on your taxes. Perfect. Yeah, taxes. If you want tax breaks now, invest in a traditional IRA. If you want tax breaks when you're in retirement, invest in a Roth IRA. Because with a traditional IRA, what you're doing is you're saying, I will defer all these taxes until the maximum of 73 years old, and at which point the government is going to say, okay, now you have to start taking your distributions, required minimum distributions. And that will all be reportable as taxable income when you start taking those distributions. So you're basically saying, I'll defer taxes to a later date to the most powerful taxing entity in the world. And I don't know what those taxes are going to be, but I'm going to defer them. Or you can put them in a Roth IRA. You pay the taxes now, and then you make the contribution, and you don't have to pay taxes on those dollars at a later date. So IRAs can, really help with tax planning. I have both. Depending on what my tax year looks like, either I'm contributing more to a Roth or I'm contributing more to a traditional, okay? So don't feel like you have to do one or the other. You can do both. But if you're only using IRAs, you can only do a maximum of $7,000 between the two or one or the other. 401ks. Now, there's all types of retirement accounts. So if you're a business owner, there's more options. If you work for a nonprofit, you're probably using a 403b. If you're working for a government, there's probably the thrift savings plan. They're all really the same, okay? What they do is your contributions are tax deductible now, you pay taxes later, and if you're in a company-sponsored plan, they will match your contributions up to a certain point, okay? So in a 401k, as of 2023, the max, if you're under the age of 50, is $23,000 a year. If you're over the age of 50, you can go up to $30,000 in a 401k. So, when you're saving that kind of money each year, that's a pretty significant portion.
Does health savings count in that number? Or
No.
is that
Health savings account is a whole nother category. Glad you brought that up, because actually, if you contribute to an HSA, which I think it's, what is it this year, $8,100 for a family plan, 60 something for a personal plan. I should have brought my fact sheet.
It's 8,300.
$8,300 for a family plan? Okay. You can save, if you have a family plan, high deductible health plan, an HSA, you can put money towards that, tax deductible now. And let's say you're 64 and you want to quit working and you want to wait till 65 to take, Medicare and Social Security benefits. You can use your HSA account to pay for your premiums for a year, your health care premiums. And it's not taxable. The IRS allows you, if you pay for medical expenses out of your own pocket and you keep the receipt, they will allow you to keep that receipt for up to 20 years and reimburse yourself. So you could say, this year my kid broke his arm and I just spent 10 grand out of my HSA to pay for that arm. Well, 20 years from now, I can withdraw $10,000 tax-free and use it for whatever I want. But you have to show, you have to be able to prove to the IRS if they audit you that you're reimbursing yourself for a qualified medical expense. And 20 years is that max. Those rules can change, so you have to be careful. You gotta have a good accountant to help you. But yeah, an HSA is a powerful planning tool that you can use if you use it wisely and use it right. All right, so
Can be will to your kids, it can be included in the will.
it can be, and it can even be, there's a new, in the Secure Act 2.0, there's even a way that you can convert it to a Roth IRA. But there's some strict limits. It's difficult to qualify for those. Do you have a question? Okay. All right, let's go back. Any questions about these accounts before we keep moving on? Okay, we're on, where did we get to? How much, 13, how much are you contributing annually towards your retirement? Okay, so we kind of went over what retirement accounts are. How much are you contributing? What's that annual number, roughly? Put that in there. Number 14, use the number of years you have until retirement. Find the appropriate growth factor in Table C. Line 15, you'll multiply those numbers together. That's the future value of your annual contributions. Line 16, add line 15 to line 11, and then that will tell you if you have a shortfall or if you have a surplus.
You don't happen to have this in an Excel spreadsheet that you can email out,
I do not,
play around with it, or,
but that's a good idea.
I mean, I have it, but
We could easily, we'll just have Clint make it up just like that fast. That's a really good idea, actually. So, if that number is positive, that's a really good thing. That means with what you're saving and what you have in retirement already, you're gonna hit your goal. If it's negative, then there's some changes that you need to make. There's some adjustments that need to be made. Okay? And remember, this is a very high level, simple way to plan out what you need in retirement, right? Because we're making a lot of assumptions, we're making a lot of generalizations. This is just a fast and dirty way to calculate a basic number, something to shoot for. And shoot high, right? Shoot high. Okay. How much time do we have? I want to give you guys some time to finish this up. So let's take maybe 2 minutes, let you finish those calculations. Think about questions that you have, and I'll start answering some of your questions. Anyone have any questions that they would like to ask?
At the risk of being dumb, I am very unprepared for retirement. So I was here late, obviously, I didn't calculate anything, I don't feel like I need to, I'm behind, I'm not in a good place. What is maybe the best way to, close that gap and to be more prepared or be as prepared as possible? Do I dump, as much as possible into, do I need to start doing risky things? Like what, because there's only a certain amount you can do yearly in like your Roth IRAs and things like that, so.
Are you a business owner? Are you employed?
I'm employed,
Okay.
so no business owner, and so I'm just trying to figure out like, hey, let's do something now because, it's better to start somewhere than just, sit in the corner and cry. But, yeah, I'm just wondering if you have any advice or if there's anything that would mathematically make sense to really close that gap. Do you know
Yeah,
what I mean?
absolutely. So, a couple things. I think it has to be more than just one thing. It's going to be a combination of many things.
Okay.
Taking more risk really is going to be determined by how much time you have left in the market. Okay? And I would submit to all of you that the most important thing when it comes to investing in retirement planning, it's not how much you have to invest. The most important thing is how long you have to invest. And that's because of the rule of 72. The rule of 72 says whatever interest rate you're going to earn on an investment, you take that number, you take 72 divided by that number, and it tells you how long it's going to take for that investment to double in size. And that's important because the more frequently your assets double in size, the more it's going to grow to. If I asked you, would you rather have $1 million today or a penny doubled every day for the next 30 days?
Penny.
Yeah, it's like $5.4 million. So that shows you how, if something can double more frequently, then a retirement account, a savings account, an investment account can grow extremely quickly. But can you afford to take those risks? Because the reality of investing in the market is, just what was it, a week ago, a week and a half ago, the S&P 500 dropped 2% in one day. That's a lot. That's a lot. In one day, you can lose 2% in one day. And if that was the day you're retiring, if you have $1 million, that's $200,000. So the sequence of returns risk becomes more applicable to you the closer you get to retirement. So you have to take what's the maximum amount of risk that you can take it. Don't take any more than that. And there's some tools and resources we have at the bank that can help you determine and actually quantify that. If you're behind, then maybe considering working longer might be a reality. What your goal should be getting to a point where you can save between 15 and 18% of your annual income. Because if you can, the closer you get to that 15 to 18% mark, then as a general rule, you're going to start hitting some of these maximums that we've been talking about. And on top of it, you're going to be investing those dollars, and you'll be amazed how quickly you can catch up. And then at the end of the day, the thing that we have the most control over is how much we spend. If you can control how much you spend, then you'll have more to save and invest in the future. So I think it's a combination of many things. But take advantage of every tax break you possibly can. So IRAs, if your employer doesn't offer a 401k, well, contribute the max to an IRA, open up a brokerage account, and you can start investing in anything you want. The great thing about not investing in a non-qualified, just regular joint, could be an LLC, it could be a trust, anything. You can open up these accounts and you can invest those dollars outside of retirement accounts.
If we have a brokerage account, but we're not gonna be contributing to our IRA out of our own pocket, can you take money from your brokerage account and transfer it over to the IRA
Yeah.
instead?
As long as you have earned income, yes, you can do that.
Can traditional IRA to be changed to Roth IRA?
Yes, you can. You can do what's called a backdoor Roth IRA. There is no limitations on when, there's no limitations on amounts, but anything you convert from a traditional IRA to a Roth IRA is taxable. It creates a taxable event. So let's say I have $100,000 and I want to change it to a Roth IRA. I could do that whole amount this year, right now. But now I have $100,000 on my 1040 that's going to report as taxable income. Okay? And there's another gotcha. If you do that, now it's a Roth IRA, you have a 5-year clock that starts. If you withdraw any of that Roth IRA within that first 5-year conversion, the IRS imposes an additional 10% tax. So you got to have enough time between the conversion and when you withdraw it.
Would it ever make sense to do that?
Yes. I can show you in every scenario, it's going to save you taxes. Yeah, because most of the time what happens, the younger you can do it, the better, because you have typically more tax deductions.
Okay, I guess at a younger age, so at my age, I can't even figure why it would be beneficial to start a Roth IRA. We should have this conversation 30 years ago. And maybe we'll just talk about it.
Yeah, we can definitely talk about it. I wouldn't rule that out. I mean, I would have to know what your income is going to look like, and can you take the whole 5 years and not take any of that money? And if you can, then there's a good chance it might be a better scenario to pay taxes now. Because I mean, the reality is, we have an election coming up. The Trump tax laws are set to expire in 2025. So if he gets in, then there's a good chance he's going to extend those. He might even reduce them, which would be awesome. But if he doesn't win, then there's a high chance that the 2025 tax laws will expire and are going to change. So,
Is that good or bad? I don't know what the Trump tax laws are. Bad?
yeah,
What?
they want to, there's, we'll see if they get what they want, but the reality is they won't. It's going to be a really long, drawn-out fight. But they want to increase the corporate tax. They're going to change they say they're only going to change taxes for those who make $400,000 or more, but the reality is every tax bracket will adjust. Probably not in your favor. So take advantage of the taxes while you can. I'm a firm believer that, the amount of money that the government spends and the deficits we have, Social Security is set to, if Congress does absolutely nothing between now and 2034, it used to be 2038. It keeps pushing forward, so this could even happen sooner. 2034, if they do absolutely nothing, then Social Security benefits from that day forward will be 20% less for retirees that day going forward. So which means this calculation that we just did will be off. You got to reduce it by another 20% on your Social Security benefit. Now, I don't know a politician who's going to run on a campaign that, hey, I'm going to reduce your Social Security benefits. So likely what they're going to do is they're going to push retirement age back further. You're going to see full retirement age go from 67.5 to 68 to 68.5. Eventually it's going to be 70. you'll see IRA accounts. It used to be 70 and a half used to be the RMD date. Now 72, and then Secure Act 2.0 pushed it to 73. Over the next 5 years, it's going to push out to 75. So the reality is people are going to be working longer, and you're going to, if you do want to retire in your 60s, you're just likely going to be taking a reduced Social Security benefit. So it means that what you are contributing to your retirement becomes more and more important as we continue on in this country, and taking it into your own hands. And then anything that you do get from Social Security, well, that's just a benefit, right? So I don't think Social Security is ever going to go away, but I do think it will get reduced. And you'll have to work longer to get your full benefit. Okay? And then lastly, what I was getting to is, if they're ever going to take care of the deficit, the only way is to raise taxes. It's just the only way. There's some other things they could do. They could get creative. I don't know if you guys know Mr. Wonderful. I thought he had a good idea. He said, open up the drill and produce oil, and then every tax dollar that is created from the selling of oil just goes to paying the deficit down. They could do something like that, but will they? No, probably not. So, planning for your retirement is, I think, more important than it has ever been. And here at the bank, we have, obviously myself, awesome people like Wade. There's a lot of things that we can do. If you feel like you're behind, I would suggest make an appointment with me. We always give a free consultation, so we can help analyze where you're at and give you some really good ideas. And if you'd like to work with us, then we have some really good competitive financial planning rates that we can offer. Awesome resources to help.
I just have a question on that. So the Roth IRA and the traditional IRA, there are those, but isn't there a Roth 401k as
Yes.
opposed to just a regular?
Yeah.
What's the difference in that?
So the only difference between a 401k and any IRA accounts is IRAs, you're only contributing. In a 401k, it's an employer-sponsored plan. So if you're contributing to a Roth 401k, then your contributions are going there, but the company match is going to traditional 401k. Now, there is a new provision where 401ks, if the company and the plan allow it, even their contributions can go to a Roth 401k. But what that will do to your taxes is that will increase your taxable income this year, and you either got to, how are you going to pay that? Are you going to take more payroll tax? So there's pros and cons to it, right?
So it's the same thing, you pay the taxes at that time, and then
Yeah. The advantage is you're getting a company match in a 401k. That's the only difference between a 401k and an IRA. One's employer-sponsored with employer contributions and whatnot. And if you're business, do we have any business owners in here? Okay. It used to be 401ks were extremely expensive and time-consuming to set up. With the advent of technology, I can get you a 401k set up in 15 minutes. And the cost is about as much as eating out twice a month. That is it. About $30 a month. If you're a solo 401k, if you have employees, still extremely affordable. And instead of paying Uncle Sam tax dollars, you can be putting those tax dollars towards your retirement. So we do have some amazing options for small businesses all the way up to large corporations.
question.
So, this is kind of off the subject, but not. As we all get older, we're more likely to fall prey to identity theft.
Mhm.
What's your best bet with identity
It seems like more and more companies coming out with identity theft protection. I know one of our next classes is going to be about fraud and those kinds of things. That might be a better question for them. But there are some, I've heard good things about
You're doing
LifeLock.
all this stuff to save money, and then someone can steal it from you.
Yeah.
How do you protect?
Well, you need to have really strong passwords, and they need to change on a consistent basis. And if they're not, then you are extremely susceptible. The most susceptible tool that hackers have into everything, your computer, even at work, is your email. If you click on, sometimes that's all it takes is clicking on the email, and then there's a PDF. You click on that, boom, you've got a virus, and they can track everything. So your email and what you click on and what you open up in your email is probably the most important thing that you can do in protecting your information. But I've heard great things about LifeLock. I don't personally use it. I know if you have a credit card here at the bank, then you at least can get free credit monitoring. They'll monitor your social security number and your name and your address against anyone from opening up credit lines without your permission. I think LifeLock goes a step further, and then they put your name out into the dark web, and if your name or email or that pops up, things like that are going to be useful. And I think that the bank is going to do more and more as technology comes out and new vendors come into play. There's more options that will come into play. So
Yeah, the Discover card, they do those for
yeah, you had a question, and then we'll go over here.
What have you found is the biggest unexpected expense in retirement that people face? So say like, maybe you have your house paid off by then or something, like are health expenses the number one? Like I don't even know what that number would look like.
Yeah, health expenses. Health expenses by far are the most unexpected expenses to plan for. If you have to go into some kind of long-term care facility, and if it's the most extensive kind, where it's actually in a facility with, doctors and nurses full-time, you're looking at $80,000 a year in most cases in the state of Utah. If you're in Florida, it's more like $135,000.
And that's out of pocket. That's not Medicare's covering any of that.
Medicare only covers the first 90 days. And then they're going to start making you liquidate assets to pay for it. And so, yeah, long-term care planning is, people are living longer than before. And that does raise concerns. When you're older, you can break bones, and the recovery period is a little bit more extensive. There's just a lot of things. So definitely, by far, medical expenses are the thing that people don't typically plan for.
Say you're not in a long-term facility, how much does Medicare cost a month, and then a supplement and deductible and stuff like that?
Well, there's a lot of options. So if you have just the basics, you're looking at a couple $100s a month. If you want the most expensive gap policies and all these other, you'd be looking at $500 to $600 a month for the extra coverage. There are long-term care policies that you can purchase. There's life insurance policies that have long-term care riders. I have clients who purchase annuities that have long-term care riders included in them. There's a lot of things, a lot of options that you can do with the assets that you have existing that can help pay for those and cover you from those kinds of things happening. And they'll help supplement. And a lot of times that's, unless you're going out and you're actually purchasing a long-term care policy right now, and the sooner you do that, the more affordable it's going to be, and the more coverage you're going to get. but long-term care is a huge portion of that planning that people don't typically think about. And we didn't anywhere in here. We didn't in here. That average expense, it just included the average Medicare and medical expenses if you're a healthy person. You know, you're going to your annual checkups, and nothing big emergency. Okay? You had a question.
Yes, so which one's more advisable, paying extra on your mortgage so you're not paying, you know, a lot of interest versus, when should you switch from paying off high interest or large interest debts versus
Investing.
paying into retirement?
Do you like Dave Ramsey?
Me?
Yeah. Do you know Dave Ramsey?
I've read one of his books, yeah.
I follow it.
You like Dave Ramsey? Dave Ramsey say pay off debt first. Pay off debt before you invest any dollars. I don't.
In between where you switch from, like at the beginning of a mortgage loan, you're paying a lot more than near the end of it, so would you like switch in the middle to focusing, cause I guess it's just an interest game, but I just wondering what your perspective is.
It's not the simplest question to answer because it's so dependent upon what you want to accomplish. If your goal and your primary objective is to get out of debt, then I would always say focus on getting that debt paid off faster. Because interest that's working against you, if you can get that out of the way, you're giving yourself that amount of raise. So if you're paying 10% on a credit card and you get that paid off, you just gave yourself a 10% raise. Yeah. Yeah. What's our interest rate on our credit cards? 13, 17, something like that?
Some of them in the 30s.
Yeah.
Not ours, but some.
But you should always pay to match. So if your company offers you a match, you should always pay
Yeah, in
up
retirement.
to, at least up to their match. So you get
Yeah.
your money doubled.
I would always advise that. So if here at the bank, they offer 7% match, I would at least do that. If your company matches 3%, that's kind of the industry standard, 3%. At least do that. Whether you do more is depend on what your investing goals are. The things, the cons to an IRA account, a 401k, typically your investing options are a little bit more limited. 401k more limited than an IRA. In a non-qualified account, you know, just a joint brokerage account, you can invest in anything you want. And there is no limits. And it's tax deferred. And you can really dictate when a taxable event occurs. But in an IRA, those restrictions are there. In a 401k, more restrictions. So depends on what your investing goals are. I have clients who only do just the minimum matching, and then we invest in very different things. And I have clients who we are focused on maximizing retirement benefits because they need the tax breaks. And that's going to do more for them than investing in other assets. So in summary, if your primary goal is to get out of debt, focus on paying off debt. And then start worrying about investing.
What are the parameters or the things that you have to watch for? So say for instance, you know, we retire at 67, we start taking our Social Security. What type of things can you do as far as working part-time without having Social Security kind of come back at you or something of that nature? What are the parameters of that?
So we're in October, we're going to do a Social Security class, and we're going to talk about that in great detail. But for tonight's class, what I would say is, if you're going to continue to work before or after you take Social Security, you have to be extremely careful, because if you make too much, up to 85% of your Social Security can become taxable. And at that point, why are you taking it? So, did you have a question? Okay. So if you're going to work, I would say wait until you're full retirement age, and then you can make whatever you want. You can work part-time, you can work full-time, and your Social Security isn't going to be affected. But it will contribute to your taxable income still, your taxable bracket, I should say.
I just had a question back on like the healthcare situation. How does it work? Let's say you have like a employer-sponsored healthcare. When you retire from that employer, does that end, or does it depend on the plan or something?
I don't know of an employer plan that continues. You can purchase COBRA, and I think you can get it for up to a year, and maybe longer if there's certain circumstances that apply.
So that's something you should probably consider, that as soon as you retire, then you're on your own as far as.
You're on your own. And if you're before age 65, then you can't apply for Medicare. So there could be a gap, and that's where HSA can come into play and help pay those premiums in those gap years. And they're not taxable. So, all right, what time is it? It's 8:03. I'm happy to stay here and answer questions and bore you to death as long as you want. If you want to get back to your families, please feel free to go. If there's any more questions, I'm happy to stick around and answer them. But if not, we are done for tonight.
Thank you.
Thanks for coming.
Do you have another one of these sheets? I'm gonna give it to Ken.
That would be great.
Yeah, that would really, you could play with the variables. Thank you, this is great.
Yeah.
You just have sheets with you.
Yeah. If you want to just leave them there, if you have something that you want to learn more about, you want to have an appointment with me, put your name and contact information down, and I'll reach out, make an appointment.
For these numbers about how much you'll need for retirement, and that's just for a single individual, right? Would we, if we wanted to calculate
Add,
income?
yeah, add everything together.
Okay.
I should have said that at the beginning.